If I told you that the most beloved star stocks in your portfolio are actually some of the worst earners in the S&P 500, would you believe me? Most retail investors judge a company by its fame or its momentum. But for the true alpha seeker, these are just noise. To see through the fog, you need to focus on one metric: net profit margin. Simply put, out of every $100 in revenue, how much actually stays in the company's pocket? According to FactSet, the S&P 500 reached a record-shattering net profit margin of 13.2% in late 2025, the highest level in 16 years. By 2027, analysts expect this to climb to 13.9%. Now, this margin is your pass or fail line. If a company earns less than this, it is officially less efficient than the market average. My name is Phoebe, and you're watching TradingKey. Revenue giants versus margin reality. Let's start with the heavyweights. Tesla's revenue is approaching $950 billion, yet its net profit margin has cratered to just 4%. That is less than 1/3 of our 13.2% benchmark. In 2022, Tesla enjoyed a 15.5% margin. In just 3 years, its earning efficiency has shrunk by 75%. Why does it still command a massive PE? Investors aren't buying the 4% margin of today. They are betting on the 80% gross margins of FSD subscriptions and robotaxi software. It is a high-stakes gamble that software will eventually rescue the hardware's failing unit economics. Amazon presents a similar puzzle. It is the undisputed king of revenue at over $710 billion, but its overall net margin hovers around 11%, still failing the 13.2% test. However, we have to look at the second derivative of Amazon's business model. Amazon is two souls in one body. The e-commerce side is a low-margin grind with 2 to 3% margins. But AWS, the cloud supplier, boasts operating margins over 30%. While Amazon's overall margin is low, its asset turnover ratio is elite. It rolls its capital faster than almost anyone else. These companies are valued on the expectation that high-margin segments will eventually become the protagonist. The untouchable money printers. If you aren't interested in waiting for a future turnaround, you need to look at the companies that function like legal currency presses. First, Visa. With revenue around $41 billion, it's smaller than Tesla, but its net profit margin is a staggering 50%. Visa owns a global toll road. It carries zero credit risk, since that's the bank's problem, and zero inventory. Once the network is built, the marginal cost of processing an additional transaction is near zero. This is a low-maintenance, high-output monopoly. Second, Nvidia. Nvidia's revenue has surged to $216 billion, but the alpha is in the 56% net profit margin. This is 4 times the S&P 500 average. While the world talks about AI stories, the real moat is its pricing power. When Microsoft, Google, and Meta are in a desperate arms race for GPUs, Nvidia can dictate the terms. A 56% margin is the ultimate evidence of an undruggable monopoly. Third, Apple. Apple is a different beast. Its net margin has climbed steadily from 21% in 2020 to 27% today. In the world of institutional investing, a rising margin is far more valuable than a stagnant high margin. It signals that Apple's walled garden ecosystem is becoming more restrictive and its customers more locked in. Every AirPod or iCloud subscription adds a layer of concrete to the moat, allowing Apple to expand margins while competitors fight for scraps. Pricing power is the ultimate hedge. As we look toward the second half of 2026, high margins are no longer just a nice-to-have. They are a survival requirement. However, we must identify the fragile kings. Microsoft sits at a 39% margin, but its CapEx treadmill is accelerating, with $145 billion earmarked for AI infrastructure. If enterprise AI subscriptions don't scale fast enough to offset this depreciation, that 39% is a historical peak, not a baseline. Similarly, Broadcom boasts a 37% margin, but it faces concentration risk. As major distributors like Google develop their own in-house silicon, Broadcom's moat could face a structural breach. Adobe faces an even deeper threat. AI is challenging the per-seat subscription model that gave it a 29.5% margin. If one AI agent can do the work of 10 designers, Adobe's headcount tax logic collapses. In an era of high interest rates and economic volatility, the 13.2% benchmark is your safety cushion. Therefore, the winners would be suppliers with absolute pricing power like Nvidia and distributors with high switching cost ecosystems like Apple and Visa. They have the buffer to absorb inflation and price wars. Meanwhile, the risks lie in companies that are currently spending for a dream, like Tesla, or facing disruptive automation of their pricing models like Adobe. The ultimate question you must ask before any trade is this: does this company have the unilateral right to raise prices? If the answer is no, you aren't buying a money printer, you're buying a treadmill. So, which money printer are you betting on for the rest of 2026? Or do you think Tesla's software pivot will defy the math? Let me know your logic in the comments. Thanks for joining me today. If you found this video helpful, remember to subscribe to TradingKey, give this video a like, and share it with a friend who might just benefit from learning this too. With that, I'll see you in the next one.